Today I want to do a deep dive into Palantir. I don't want to talk about stock prices. I don't want to talk about the fact that it's been running up hundreds of percentage points in the last couple of months, that it's been making people a lot of money. I don't want to talk about whether you're going to lose all that money. All I want to do is just analyze the company. Let's see why you would put your money in. Let's see why you might want to reserve your money for a better company, for something that might come in the future. Let's talk about it. So thank you so much for watching. I hope this helps. Please like, please subscribe. I really appreciate your time, and I hope you enjoy the video. So I want to start at the beginning. What is Palantir? So Palantir Technologies is a company that builds software platforms for institutions whose work is essential for our everyday life. Company began in 2003, essentially building software originally for the United States intelligence community, specifically to assist in counterterrorism investigations and operations abroad in Iraq and Afghanistan. They later began working with commercial enterprises and not-for-profit organizations, specifically to meet their various demands and needs. So currently the company has contracts with the CIA, FBI, NSA, CDC, Marine Corps, Air Force. You get the point. In terms of their commercial enterprises, some of the names that use their service are Hershey's, using their software for global food deliveries, Chase Bank for their security and their data analysis, and many other companies, by the way, who are very successful major corporations. So the company essentially has two primary software platforms, Gotham and Foundry. So let's just quickly discuss these. So Gotham enables users to identify patterns hidden deep within large and complex data sets. For example, in Iraq and Afghanistan, the US soldiers were mapping networks of insurgents and the makers of roadside bombs, and they were doing this all by hand. So this is, like looking for a needle in a haystack. The problem was that they didn't have the software that they needed to do the job properly. So that's where Palantirs Gotham came in. So Gotham enabled the U.S. forces to identify signals intelligence sources to reports from confidential informant, and ultimately helped the U.S. personnel respond to those threats. The company later realized that many commercial institutions, including banks, financial services, and firms, and a whole host of other state and local governments, they face many of the same challenges that Gotham was originally to combat. So that's when they designed their other system, which is called Foundry. So Foundry essentially transforms the way organizations operate by creating a central operation system for their data. Individual users can integrate and analyze the data they need in one place. So essentially it collects a lot of data from the company, and the company executives are able to, positively affect their bottom line. Basically, they have a very good product, and that's what essentially you want to know. So here are the pros. Here is the bull case thesis. So first, let's talk about the demand and the total addressable market. So the total addressable market for Palantir's product and service, obviously important to have demand for your service and not just supply. So the company estimates that the total addressable market for their software across the commercial and governmental sectors around the world to be approximately $119 billion. So that's, by the way, excluding many of the countries where the company currently refuses to provide their service and products. So the number is obviously likely much higher in terms of total addressable market, in terms of market share, market for their product and service. So third parties, by the way, have confirmed that. They estimate that the market to reach $126 billion in worldwide revenue by 2025, which implies a compounded annual growth rate of 43% until 2025. So huge market. Company is currently defending itself well against its competition by expanding their market share across the globe. For example, in 2020, June, they reported their $500 million partnership with Sompo Holdings, a major Tokyo-based insurance company and Japan's leading nursing care provider. So obviously that expansion is important, and for them to eat up some market share and take away from their competition. Let's talk about the numbers. Company generated $742 million in revenue in 2019, reflecting an increase of 25% from their revenue in 2018, which was $595 million. Obviously a company that's growing. In the first half of 2020, during a period of significant geopolitical instability and economic contraction, company generated $481 million in revenue, and that's up 49% over the same period last year. So during a global pandemic, the company is doing well. That's a very good sign. Let's talk about the numbers that the company reported. Obviously, everybody wants to know in the last quarter, how's the company doing now? So the third quarter of 2020, the company reported revenue of $289 million, and that's up 52% from the third quarter of 2019. So again, just all of these numbers indicate that the company is growing. Its revenue is growing. That's very important for investors to know, because that means that the company there's demand for their product. People are paying for their product. That's good. The company has also improved their operating costs. In other words, the company is becoming more efficient. So for example, in 2019, the company incurred net losses of $579 million. But when you deduct the one-time stock-based compensation, they reported a net loss of $137 million. Next time when there's no one-time stock-based compensation that is added to their losses, they can have significantly less losses. In the first half of 2020, the company's, however, net loss decreased to $164 million, or $17 million net income when you reduce the stock-based compensation. That's down from a loss of $280 million in the first half of 2019, or $167 after those stock-based compensations. Essentially, what that means is that the company's revenue is growing and they're cutting their losses every quarter, every year. That's great. Company also improved their average revenue generated per customer, which means that people are paying more. Each customer is paying more. In the first 9 months of 2020, average revenue per customer was $5.8 million. That's up from $4.2 million, or 38% from the same period of time the previous year, which means that each of their clients is now paying more for their service, or adding at least additional services. That is a huge and incredible sign for a company. Additionally, the company improved their customer concentration. Essentially, customer concentration means how much of your revenue is coming from a specific amount of customers. So in the 9 months ending September 30th, 2020, revenue from their top 20 customer constituted 61%, but that's down, that's a huge number. We'll talk about that in the bear thesis, but that's down from 68% for the same period of time last year. So they're cutting that down. That's really good. Company's cash position is also currently very strong. Cash and cash equivalents are estimated by the company to be over $1 billion. So that's huge. That means that the company can, do well in a time of constraint. In terms of the future guidance, obviously very important for investors to look to the future. The company expects 31% revenue growth for the in the fourth quarter of 2020, and more than 30% growth in 2021. So obviously that's very significant. So another thing that's very important to mention is the fact that the company has recently signed a contract with the FDA so that they would track the vaccines and essentially help with vaccine deployment. So that's obviously a good thing, because many tech companies are wondering if they can sustain the level of growth that they received during the pandemic, because everything moved on, over to technology online. So they were worried that they might not be able to sustain the level of growth. But the fact that Palantir is partnered with the FDA for vaccine approval shows that in a post-COVID world, they might still benefit and profit. So let's talk about the bear thesis. Let's talk about why people should be potentially concerned. So the company, first of all, is not yet profitable, and it's incurred losses in each year since its inception. So specifically, they incurred net losses in the third quarter of 2020 of $847 million. Again, we discussed that much of this is due to one-time stock-based compensation for insiders, but still relevant for investors to consider because that's not a lot. That's still a loss. And also, the company said in its filings that they might not turn a profit for a while in their S1 filings with the SEC prior to IPO. Company also has a forward PE ratio of 226, which is very high. That means that they're not earning what the share price indicates, and that's so divorced from the balance sheet, divorced from reality. So you want that to come down, obviously. For a high growth company, although, it's not insane as long as they continue to execute, and then their PE can obviously come down. Another issue for the company is the fact that its government contracts represent over 50% of their revenue. So there are several issues that I want to discuss with that. First of all, in certain events, it exposes the company to serious backlash, maybe even lawsuits, if they engage in potentially controversial government activities. So let's give an example. In 2018, Palantir provided the U.S. Immigration and Customs Enforcement, ICE as you know it, with the digital tools to aid in identifying undocumented immigrants. That could be a problem. Let's consider that Amazon contracted with the government to provide facial recognition to law enforcement, and also Google contracted with the government to use their AI technology to create weapons of death. Both face major backlash for engaging in these contracts, and what happened as a result? They both canceled. So that, as of now, Palantir isn't showing any sign of not working with the government. But in the future, if they receive enough backlash from the public, from certain NGOs, non-governmental organizations, civil rights groups, that could change, and that's a big problem, especially given that more than 50% of their contracts are government contracts. Another issue is that government administrations change. We saw in 2020, Trump lost the election, or Biden won, and so that's going to be a significant shift. Different administrations, I don't have to tell you, employ different people. That obviously creates uncertainty for a company that's relying specifically on government organizations to give them contracts. On a similar note, or also government contracts are not provided necessarily on a fully merit-based system. So sometimes politicians are doing favor for their donors. There are a whole host of reasons why certain companies get government contracts. So again, that creates a level of uncertainty for the company if they are relying specifically on government contracts. Another potential issue with the bulk of the revenue stemming from government contracts is that it does limit its opportunity for the company to work with various other governments, who might be interested in contracting with the company, but won't for obvious reasons, chief among them being that there's a clear conflict of interest. Another risk for the company is that they collect a huge portion of the revenue from only a few clients. Again, the client concentration. So in 2019, for example, the company reported 125 customers, but 20 of those generated 68% of total revenue. So obviously that puts a lot of pressure on the company to retain the few large clients. That's obviously an issue. But also imagine how some of their smaller clients feel, if you wonder if they're receiving some of the same level of service as the larger companies. Again, we did talk about how they, in the bull case scenario, how they did reduce that number in 2020 to 60%, but I'm going to say, there's still a concern because 60% is very high. So let's see in the future if they can bring that down. But if it's at 60%, most of their client is producing most of the revenue, that's obviously a big issue. Because think about, in the contrast, by the way, think about, let's say, Facebook. They had, earlier this year, there was an ad boycott for Facebook. But the numbers didn't really affect them because they have many, many different clients that are giving them a bunch of their revenue. So they still maintained their numbers, and they still grew at exponential rates every time that, during this boycott, they reported their earnings. So it didn't affect them as much. So obviously that was a positive for Facebook. So another issue that investors and potential investors should definitely know about is that the company heavily relies on some of their executives. So on its CEO, for example, Alexander Karp, and several other executives, specifically to move them forward to success. So this might sound menial, but it's definitely worth mentioning and worth taking into account because, think about what the company does. They work for high-level government agencies, mostly, and so it could be very difficult to find highly qualified applicants for the various positions, and also highly qualified applicants that are able to obtain high-level government clearance. So there are a few hoops that potential employees have to go through, and that could be an issue. The company also disclosed recently that each of their executive teams are at-will employees and can terminate the relationship at any time. If that happens, then the company believes that it would be very tough to find a suitable replacement. Again, the company itself reported this in their S-1 filing with the SEC. By the way, think about another company that has that issue or potential issue, maybe not anymore, or maybe not as dire anymore, but Tesla. Elon Musk is seen as the visionary behind the company. People are obviously extremely worried if something happens to him. He is, handing over the reins in certain ways, and the company is becoming more established, but it's, something to worry about. So Palantir has the same issue. So here's my analysis, my final analysis about whether it's a buy, sell. Obviously it's your money. I don't want to tell you what to do. I personally do not yet hold a position in Palantir. Obviously, over the last couple of weeks, many news reports, many news outlets reported on the stock and how well it's doing. That doesn't make me buy. I think there's a lot of good, a lot of growth, and a lot of demand for the company. I think the company is cutting its losses. It is growing in revenue. It is showing that it could produce. And with some of the contracts that it has been receiving as of late, some of its clients, so there's a lot of good. But I just wouldn't start a position at this level. I think everything's overvalued. I think it's definitely overvalued. Obviously, it IPO'd in September and it just flew hundreds of percentage points. That is not healthy. That means that it's more speculation. Investors are just putting their money everywhere. And we see it with many other stocks. So, I would want to see the company execute further, and I would wait for a pullback, and really I would wait for both of those. Essentially wait a few quarters, see how the company is producing. Are they growing in revenue? Are they cutting their losses, et cetera, et cetera? And then if the stock price lowers, then I would think about starting a position. I would also highly recommend that if somebody did benefit off of the major run that it took since its IPO, I would definitely lock in profits. I don't think there's anything wrong with that. I think you can also buy back if you really believe in the company after that. Look, I think if you're planning to start a position, if you really believe in the company, I would start a small position and then I would dollar cost average. In other words, every time the stock price dropped, even a few dollars, I'd put a couple more dollars in, buy a couple more shares. That way, your average is going to be a lot lower when it ends. So that concludes my analysis of Palantir. I hope that was helpful. Again, it's your money, so you have to be comfortable with the level of risk that you're willing to take. Please do your own research. That was just my research and my own opinions. Obviously, I would love to know if I missed anything out. Please comment, please like, please subscribe. Really appreciate your time, and we'll see you next time.